Good afternoon. Thank you for participating in today's presentation concerning anti-money laundering regulations as they apply to registered broker-dealers, and specifically the independent audit requirement. My name is Stephen Squire. I'm the head of broker-dealer consulting for Cordium, a multinational consulting firm that specializes in the financial services field. During the presentation, you can submit questions using the questions field in the GoTo console. Please be advised that we may not have sufficient time at the end to address all questions. You can contact us directly if we are unable to address a question submitted. As you can see from the contents list, I will be providing a synopsis of applicable anti-money laundering obligations, the genesis of those requirements, and then spend the rest of the presentation addressing the audit function. You are no doubt aware that the USA Patriot Act and its origin, the Act amended an earlier enacted regulation applicable to financial institutions, the Bank Secrecy Act. The USA Patriot Act requires, which may sound familiar to you, the development of internal policies and procedures and controls, the designation of a compliance officer, an ongoing employee training program, and most importantly for purposes of today's presentation, an independent audit function to test the program. These are very similar to the requirements of FINRA Rule 3310, formerly NASD Rule 3011, which was adopted 1 year after the US Patriot Act was adopted. Rule 3310 incorporates all of the applicable regulations and requires firms to establish and implement an AML program, including policies, procedures, controls, the designation of an AML compliance officer, ongoing employee training, an independent audit to test the AML program, and the creation of a customer identification program, the CIP. So we find ourselves with the Bank Secrecy Act of 1970, which requires the reporting of certain transactions and addressing structuring. The USA Patriot Act, as we have just revisited, the Money Laundering Control Act of 1986, which imposes a general obligation to be diligent in the review of the source of money or to be labeled a money launderer, the Financial Crimes Enforcement Network, FinCEN regulations, as you're probably aware, the bi-monthly account checks, and FINRA Rule 3310 and its municipal relative, MSRB Rule G41. Since 2002, FINRA has continued to expand the breadth of the AML examinations, which has resulted in increased examination findings. This includes the failure to establish and enforce adequate AML programs, identify red flags, investigate suspicious activity, and file suspicious activity reports, conduct independent testing, conduct required AML training, and to detect deficiencies in key AML requirements, such as the CIP. Other examination findings include failures to report to senior management and board of directors, or ineffective follow-up documentation, or having an action plan. A poor independent review is a key factor in AML violations, which affects the time that a regulator takes in conducting an AML examination. The independent audit function is not a best practice. It is a regulatory requirement. A key element of the review is that it be independent. That means independent of the compliance function and independent of those implementing the AML program, such as the operations staff. The review can be performed by internal audit, an independent consultant, or a non-conflicted employee, but they must be well-versed in AML laws and rules and have an understanding of the potential money laundering risk across business lines. Sufficient staff and time to perform the independent review are required as well. This includes a review of the firm's risk assessment, as well as an understanding of the number of business lines, products, transactional volumes, new customer types or business lines, and IT AML systems. The staff will need to test for compliance with all applicable rules and regulations, as well as the firm's internal controls. The review staff must evaluate the integrity and effectiveness of the AML compliance program, including the customer identification program, customer due diligence, and high-risk transactions with an emphasis on high-risk areas. The review staff must also look at the adequacy of the staff training program and systems used for identifying and reporting suspicious activity. For purposes of planning, the review staff should conduct discussion with senior management, focusing on the compliance program, the firm's risk assessment, customer and jurisdiction profiles, the firm's offerings, suspicious activity monitoring, monitoring reports, systems utilized, and any changes in the business focus and infrastructure. The review staff should also examine prior independent AML examination reports and management responses, regulatory reviews and inquiries, applicable AML provisions of the fully disclosed clearing agreement, and the firm's organizational chart by businesses, entities, and structure to assess money laundering risks. This should ensure coverage of the entire AML OFAC program and allow for a risk-based review, which allows the independent reviewer to allocate their time and staff resources to areas of greater risk and commit to heavier testing of internal controls. The policies and procedures should be assessed to determine currency, comprehensiveness, and the knowledge and staffing of the AML compliance department. The firm's policies and procedures should be reviewed to determine they address identifying higher risk customers, products, services, and geographies, risk-based customer due diligence, record keeping and reporting requirements, controls and monitoring systems, timely filing of required reports, transaction monitoring, and the use of exception reports. The review should also confirm the annual training of personnel, regular updates to the AML program, independent testing, and that senior management is involved and aware of any deficiencies and corrective actions taken. The firm's risk assessment can assist the reviewer in determining what management believes are higher money laundering risks. Where there's no risk assessment, part of the review will have to be to create one with the objectives of identifying money laundering, terrorist financing exposure, and measuring potential money laundering, terrorist financing risks. This should include an assessment of the firm's products and services, including higher risk activities such as foreign securities, micro-cap penny stocks, physical stock, certificate deposits, cash management accounts, and third-party wires. The firm's risk assessment should also address the type of customers the firm deals with, including individuals, whether they be foreign or domestic, entities, again, foreign or domestic, as well as the type of businesses they engage in, the length and time of the relationship, the purpose and type of the account. Higher risk customers include non-resident aliens, certain high net worth individuals, cash-intensive businesses, entities and offshore tax havens, hedge funds, and trusts. As well, the risk assessment should address geographic concerns such as countries subject to the OFAC sanctions, supporting international terrorism under the Export Administration Act of 1971, of primary money laundering concern by the Secretary of the Treasury, subject to special measures pursuant to Section 311 of the USA Patriot Act, identified by the Financial Action Task Force on Money Laundering, and offshore financial centers in other countries identified based upon prior experience. The risk assessment should also address the firm's SIP, Know Your Customer, OFAC review, activity monitoring, and additional items. Other concerns to be mindful of are situations where the firm maintains strictly manual controls and or newly adopted compliance systems. Many firms, such as bank-affiliated broker-dealers, dual-registered RIAs and BDs, and firms with multiple registered broker-dealers may adopt an enterprise AML program, whereby a single program addresses the needs of various regulated entities. The reviewer should ensure that internal controls address all related companies and determine control weaknesses or suspicious activities at one company are addressed, as they may heighten the risk at a related company. A review of the controls in place should include any service level agreement for outsourced AML support, and that the company receiving the AML support monitors the effectiveness of the services received. With that said, now the testing can begin. The reviewer should conduct interviews concerning the AML process with the staff, including the BSA, AML officer, key executives within major business lines and support units, and front office management to determine their awareness of the responsibilities in the AML control process. For the SIP and KYC reviews, a sample of active and recently opened accounts, obviously with a greater percentage of high-risk customers, should be obtained. The reviewer should determine what documentary and non-documentary records are obtained, that such documentation is in compliance with both regulatory requirements in the firm's AML policy, and that the risk-based review is appropriate given the activities of the client types reviewed. Regarding regulatory reporting, the reviewer should examine the firm's suspicious activity review process and suspicious activity reporting, including samples of filed SARs and any situations where determination was made not to file a SAR, even if the circumstances may have warranted it, to determine the rationale for such decision. A representative sample of accounts should be reviewed to determine that proper documentation of OFAC queries is maintained, under what circumstances accounts are opened, non-documentary methods, and determine if any OFAC compliance-related functions are performed by any third party, and if so, how this is documented. The review should also include the self-verifications maintained for FinCEN. This includes confirming the methods by which names on the list are reviewed against customer data, especially a clearing from database, internal records, or other methods that are used by the firm. All reviews should be conducted and matches must be reported in a timely manner. The reviewer should determine how transaction reviews are conducted and what tools are used to ensure a reasonable sample of customer and transactions are reviewed, including higher risk categories such as active trading, high risk accounts, substantial money movements, third-party wires and checks activity, low-price securities activity, etc. The firm's AML and OFAC automated monitoring systems should be customized to address the specific money laundering risks of the firm. That's the reason a review of the risk assessment and discussion with senior management are key to the process. The reviewer should evaluate the methodology of the system and the end product to determine the required customer information and transaction data are entered into the system. The reviewer should sample activity to test the quality of alerts, evaluate the follow-up of any such alerts, and learn how any false positives are identified and documented. In regard to voluntary information sharing, the reviewer should confirm that initial and annual notices are filed with FinCEN prior to sharing permissible information. This can be done through a review of the regulatory and law enforcement request and supporting documentation. A review of money flows is a key element of any anti-money laundering review. A sample of payments, wire transfers should be examined, including inflows and outflows of cash for active customers and third-party wires and checks to determine whether OFAC checks are conducted on such third parties. Last, but by no means least, the reviewer should determine that the firm's designated AML compliance officers' working knowledge of anti-money laundering is sufficient by reviewing their work experience and training, and that the department has sufficient resources, including staffing and support. The reviewer should confirm all required persons have completed AML training, that the materials are appropriate for the audience and comprehensive enough to address applicable job responsibilities. While the on-site portion of the review may be complete, an important component of the overall exam is the audit work paper and final report. Both should be detailed, thorough, and easily followed by a regulator. Assumptions and methodologies should be properly described with rationale documented, as well as a discussion of how population and sample sizes are determined to be appropriate. Reports need to be significantly detailed. The final report should include the AML requirements being tested, specific observations regarding the firm's policies and procedures, all findings from the testing results, and recommendations to address identified gaps. The findings should be reported directly to the board of directors or an audit committee. This provides notice to regulators that management is aware of issues and is hopefully addressing them. A robust independent review program can help identify and address AML control weaknesses before they become a problem and are identified during a regulatory examination. This can help the firm avoid regulatory examination findings, fines, and costly transactional look-back reviews, as well as the reputational risk of AML OFAC violations. And that is the presentation. Let's see if there are any questions. And let's see, first question I have, are there any exemptions from the independent audit requirement? And the answer to that is yes and no. Where a broker-dealer engages solely in proprietary trading or conducts business only with other broker-dealers, then the independent required testing is only going to occur every 2 years. However, there's absolutely no exemption for any of other AML requirements. Basically, the independent audit must take place. The timing of it, again, would depend upon whether there are public customers of the broker-dealer or whether they are dealing strictly on a broker-to-broker basis. And let's see, second question, what documents must be retained for the review? Basically, you should retain a copy of the completed audit program, evidencing your samples and reviews, as well as a preliminary and final audit report. Interview notes, communications on other work papers should be retained, but not necessarily provided to the regulators unless they specifically request them. Obviously, you want to make sure that you provide as much detail to the regulators as is necessary without providing them more information that they've basically asked for. And looks like I don't see any other questions at this point. So if there are no other questions, I would like to thank you for your time and invite you to contact Cordium if you have any questions on today's materials or would like to discuss our compliance consulting services. Thank you very much.